Welcome, everybody. September 23rd, the start of yet another new week. Scott Riley, the market update desk, NMLS number 157524. Well, we got through last week with the higher than initially anticipated rate cut of 0.5%, on top of some hotter than expected retail sales. What did that end up doing? We had a great week in the bond market, but we did retreat on the 10-year and increase slightly on mortgage rates after the Fed cut. Now, people, we have to remember that just because the Fed decreased or increases rates does not correlate to a mortgage change. Many of these changes are already built in, so to speak, many weeks before the actual event happening. And that's why we went up just a little bit in mortgage rates and the 10-year bond. This week, we have a slew of Fed members coming out and speaking. In fact, our favorite Fed speaker, Fed Governor Bowman, I believe is speaking 3 times this week. Realistically, she's going to look to justify her dissenting opinion of a 1/4 point versus 0.5 point. Keep in mind that was the first one in, I believe it was 19 years, a dissent. So she's going to be out there probably spinning a little bit, trying to look a little bit better than what her vote was. Now, today we did get a speech from Fed Governor Waller, who's a voting member, and realistically, he's one of the most influential members on the Fed. So his words do carry quite a bit of weight within the committee. He was asked why the Fed did 0.5 point versus a 1/4. He said, quote, inflation is at a lower path than we're potentially expecting. I think inflation is on the right path as long as we don't let it get too low, unquote. It's very interesting to see him talking about not letting inflation get too low. So now we have some new words out there, some new interesting aspects we really need to pay attention to. Begs the question, are they seeing something behind the scenes that we're not? So we want to pay close attention to that. Minneapolis Fed President Neil Kashkari also spoke and defended the cut of 50 basis points. He said he believes that even after the cut, the Fed is still restrictive as we are right now. He wants to see another 0.5 point this year and thinks the risk to unemployment rate rising have increased. Kashkari explained, quote, the balance of risks has shifted away from higher inflation and towards a risk of further weakening in the labor market, warranting a lower Fed funds rate. Even after the cut, the overall stance of policy remains tight, unquote. So we definitely have this group within the voting members that want to see a quicker pace, it seems like, of cuts and a bigger pace of cuts than maybe the far hawk side of maybe a third of the members. In fact, I was listening to an interview today on CNBC, one of the CEOs talking about, wow, if we get above 4.4% unemployment, and we talked about that last week, you could see successive 0.5 point cuts. So this nuance and this idea is now out there to go, hey, maybe this 50 basis points is not a singular event. And even Chairman Powell talked about, they don't want to get behind the curve, and he thought that they were right where they needed to be, where many of us looking at the employment numbers thought they were behind the curve and not watching enough the unemployment numbers and the job creation numbers that are actual, not the pre-revision numbers, but the post-revision numbers from BLS. So the big news this week is going to be PCE, personal consumption expenditure. The market is expecting headline to come in at a cool 0.1 for August. That would bring the year-over-year headline from 2.5 to 2.3%. The reason for that is we do have a very beneficial replacement number in headline. But the more important number is going to be the core rate, and that's expected to rise somewhere between 0.2 and 0.24, depending on which estimate you're looking at. Even though this would not be a terrible monthly reading, The replacement number from last year is really brutal. It's low at 0.098, not even a tenth. So any increase that we're going to get is going to raise the year over year. So the market's expecting year over year to increase from 2.62 to 2.7%, maybe even 2.8. The market, though, should be anticipating this because Chair Powell gave the estimate during last week's Fed meeting of the expected year-end rate still to be at 2.7% on the core. Now, keep in mind, some people are really focusing on the 3-month and the 4-month super core and annualized rate. So we'll see where that all comes in. On the technical side, the 10-year bond did definitely pop upwards from its low point right after the Fed decision. So we're hanging in at about 3.76 right now. That's an important level of resistance. It's at the 25-day moving average. Our next topside resistance is 3.92, which would definitely put upside pressure to mortgage rates. So we'll keep watch of all this, get the news out to you so you can be up to date. Appreciate you watching. Give us a call. We'll help you get pre-approved, get rates locked in, and help you get your offers accepted. 616-293-2189. The Market Update Desk is your original singular market news source for West Michigan. Do us a favor, like, share, and comment on this if you could. Have a great day.